Yes, very good morning again. So this is what we have entered into in the last class, and would be continuing our discussion on this. Just, I hope I am audible clearly. Yes. So this is what we have entered in our last class. Set off and carry forward of losses. It means how do we neutralize the profit of one source and the losses that are being made through the other source. Okay, so basically the main motive is to neutralize the impact of earning with losses. Okay, so basically we have income from these following five heads, that is income from salary, income from house property, and income from profit and gain from business and profession, capital gain, income from capital gain, and income from other sources. Let's talk about income from salary. See, when it comes to salary, basically there would be no possibility of losses generating through salary. So there is no scope left for neutralizing any impact here, because salary is a safe form of income or secured form of income. Generally, the employer pays the salary to the employee every month. So here, the chances or the possibility of losses doesn't exist. Okay, so uh, losses of salary doesn't require as there is no loss, so uh, there is no scope for neutralizing any impact here. Okay. Now let's talk about income from house property. When it comes to house property, there is a possibility that there could be some loss from the income of the house property. So here there will be a scope for neutralizing the impact of losses that is being made through the house property. For example, if there is only one house and there is a loss from that house, so such losses can only be set off from the income from the house property. Okay. Uh, Sorry. Such losses can be set off from any other source of income as well. Okay. So if there is a income from house property and the person has only one house and that single house is in loss, okay, there is a loss from that house. So that loss can be set off from any other heads. You can set off either from income from salary or income from profit and gain from business, or through capital gain, or through other sources. So any losses that is derived from income from house property, especially in case of where there is only one house. So such losses can be set off from any other source of income as well. To what extent it can be set off? It can be set off to the extent of rupees 2 lakh. Okay, and despite of setting off the losses uh, up to the extent of 2 lakh, if the losses are not absorbed still, then these losses can be carried forward for next 8 years. Okay. So this is the case of income from house property. When it comes to income from house property, if there is only single house, then in that case, the set off can be done from any other heads. Okay. The SSC can set off the losses from any other head. But what if the uh, what SSC has multiple in case of houses, the SSC can set losses from any other house property, or else if the losses are not completely absorbed, if the losses are not completely absorbed despite of setting off this year, then it can be carried forward for next 8 years. Okay. So this is the case of income from house. Say income from profit and gain from business and profession. In case of profit and gain from business and profession, see, basically we have classified. One is the losses from speculative business. So if there is any loss from the speculative business, it can only be set off from the losses of the speculative business only. Okay, you cannot use any other heads of income for setting off the losses that you have made from speculative business. Speculative business can only be set off from the losses of the speculative. Okay, despite this loss, if the losses are not completely absorbed, then this losses can be carried forward for next 4 years, and it can be set off only from the losses, only from the gains of the speculative businesses. Okay, only from the gains of the speculative businesses, only from the profits of the speculative businesses. Okay, so just remember, in case of house property, the losses of one house can be set off with the profits of another house. Okay, and in case where there is only one single house property, so uh, the losses of house property can be set off from any other head, and to the extent of rupees 2 lakh, and despite of setting off, if the losses are not completely absorbed, then it can be carried forward for next 8 years. Okay. Then we have loss from business under loss from specified business under section 35 AD. Okay. See, here you can set off these losses from the profit made by any other business. Okay. For example, in one business you have a profit, from other business you have a loss. So here the impact can be neutralized. The impact of losses can be neutralized with the profit made by any other business. Okay, and despite of it, if it has not been completely absorbed, then it can be carried forward for the next 4 years. Okay, you can carry forward these losses, and in a phase out manner, you can absorb these losses from the profits made in the next 4 years. So losses from the losses from the specified business under section 35 AD, they can be set off from the profit of any other businesses, or else if the losses are not completely absorbed in a specific year, then it can be carried forward for next 4 years. Then we have losses from any other businesses. So if you have losses from any other businesses, that can be absorbed, that can be neutralized, it can be set off from incomes from any other head except income from salary. Okay, so this impact can be neutralized from any other head. You can use any other head for neutralizing the impact of these losses. From you can set off these losses from the incomes that you derive from any other sources, but not from the salary. Okay, and despite of setting off, still if there is uh, any losses left, okay, so such losses can be carried forward for next 8 years. Okay, and it can be set off from the business income. Okay, it can be carried forward for the next 8 years. So but this specific page gives you everything. Okay, so it's out for making or preparing notes as well. Then we have capital gains. See, what is capital gains? Like I purchase shares, and shares worth rupees 30,000, and this value will not remain stagnant. It won't remain consistent. Uh, it may rise, it may fall. Okay, there will be a continuous fluctuation. So just suppose if there is a rise, that generates a income. Okay, if there is any rise in the value of the share, that basically gives me income. So we have two kinds of capital gains. One is short-term capital gain and one is long-term capital gain. Like you have, so you can notice there has been continuous rise in the prices of gold. So it is basically rise in the capital. Yes or no? The value of the gold is rising. So just a second, just a second. Just one second. So, there was certain fluctuation in terms of internet connectivity. Hope now it is audible and there would be no disturbance in terms of internet. Okay, so we'll continue. Okay, so see now when it comes to capital gain, yes, when it comes to gain, we have short-term capital gain and long-term capital gain. Okay. See, if there is any losses from short-term capital gain, it can be set off. The impact of those losses can be neutralized with the profit made from or profit generated from either short-term or long-term capital gain. And still, if the losses are not absorbed, those losses can be carried forward for next 8 years. And in a phase-out manner, these losses can be neutralized over a period of time. Okay. So remember, the short-term capital losses can be set off from the short-term capital gain as well as from the long-term capital gain. Okay. So if there is any losses from the short-term capital, that can be set off from short-term capital gain and from long-term capital gain. And if it has not been absorbed in first year, it can be carried forward for next 8 years, and in a phase out manner, the losses can be neutralized. Then we have long-term capital gain. See, long-term capital gain, the losses can be neutralized. The long-term capital losses, it can be set off. It can be set off only from long-term capital gain. Okay. So if there is any loss from long-term capital gain, if there is any loss from long-term capital, it can only be set off from the long-term capital only. And it can also be carried forward for next 8 years. Okay. And in a phase out manner, it can be absorbed in the next 8 years. Then we have income from other sources. Now, just look into it, income from other sources. See, there are two kind of other sources. Basically, I have classified here. One is loss from horse race and the other one is other losses. See, loss from horse race. What is loss from horse race? See, this comes under your other sources. It can only be set off from the profit from horse race, or else this can be carried forward for next 4 year. And in 4 year phase, it can be neutralized slowly. It can be absorbed slowly. Okay. So this particular page defines you everything. Okay, one by one, each head you can understand. Income from salary, there is no scope of loss, so there is no need of set off. When it comes to income from house property, okay, when it comes to income from house property, there is a possibility of losses from house property. So if it is a if you have a multiple house, then you can set off the loss of one house with the profit of another house. If you have only single house, then set off is permitted from any other head to a extent of 2 lakh rupees. And if it has not been absorbed completely, then it can be carried forward for next 8 years. Income from profit and income from profit and gain from business and profession. We have three categories here. I have classified here clearly: loss from speculative business, loss from business specified under section 35 AD, and loss from other businesses. So if you have loss from speculative businesses, It can only be set off from the profits of speculative businesses. And if it has not been completely absorbed, it can be carried forward for next 4 years. Then if we have losses from any specified business under section 35 AD, then these losses can only be set off from the profits of the specified business under section 35 AD only. You cannot use any other head. And in 4 years, it can be carried forward. It can be carried forward for it can be carried forward for next 8 years. Okay. Then we have loss from other businesses. So when it comes to loss from other businesses, here the set off can be done from any other heads as well except the salary. You cannot use a salary for absorbing, for neutralizing the losses from other businesses. And it can be carried forward for next 8 years. And in the 8 years phase, the losses can be absorbed from the profits made during these 8 years. Then this is what you have to learn. Okay. Then short-term capital loss and long-term capital loss. If there is a short-term capital loss, the set-off can be done either from the short-term capital gain or long-term capital gain, or else it can be carried forward for 8 years. And in the 8 years, it can be set off in a phase-out manner. Then you have long-term capital losses. Long-term capital losses can be set off from the long-term capital gain only. Okay, you cannot set off the losses of long-term capital gain with short-term capital gain. Okay, long-term capital losses cannot be set off from short-term capital gains. It can only be set off from the long-term capital gain. And if it has not been absorbed, it can be carried forward for next 8 years. And in phase-out manner, you can dissolve this. And then income from other sources, we have one thing called loss from a horse race. Okay, so that can only be set off from the profit made from the horse races, or else it can be carried forward up to 4 years. And it can only be set off from the profit made from the horse races only. Now let's move on to another topic. Just give me 2 minutes. I will share my screen and we will move on to the next topic. Yes, hoping that this is visible. This is your another unit, which is deduction from gross total income. Now, before we start this deduction from gross total income, let's understand what does this deduction means and why do we allow deduction to the SSC? See, deduction is basically to reduce the tax burden of the SSC. Okay, the primary motive of allowing deduction is to reduce the tax burden of the SSC, and also in one way to encourage savings. Okay, the primary motive of the government behind introducing this deduction or allowing this deduction is to encourage saving habits in the public at large, and also to encourage investments. Okay, so yes, ma'am. So also to encourage investments. Uh, See, we have different sections starting from section 80C to 80U, which talks about different deduction that is allowed to the SSC. And these deductions are available from his gross total income. And once the deduction is claimed, that will reduce the tax liability of the SSC. Basically, it will reduce the tax burden of the SSC. Okay, if any of the deduction is availed by the SSC, so if the SSC avails any of the deduction, that reduces his tax liability. See, under section 80C, I told you there are some deduction that is basically to encourage the saving habit of the person, and there are certain other there are some other sections which allows deduction basically to encourage um, investments as well. Okay, to encourage investments and for social welfare also. Okay, certain deductions have been allowed just to encourage social welfare. Okay, like you have um health and uh, health treatment. Okay, so these are basically aiming for promotion of social welfare. Now we have, let's see one by one. Section 80C. See, Section 80C is basically for investments and payments. The maximum limit of deduction what SSC can avail is 1,50,000. Okay. So see, under this, if you are paying LIC premium or EPF or PPF, any contributions you are making, or tuition fees up to two children's. Okay. If you are paying any housing loans, if you are contributing to Sukanya Samriddhi Yojana, so any form of investment if you are doing, either in the form of LIC or say Sukanya Samriddhi Yojana, so a maximum deduction of rupees 1,50,000 is allowed to the SSC. Okay, under section 80C. See, basically here we have to remember the sections. Okay, if you remember the sections and if you remember what things are being covered under each section, that gives you the entire summary of the chapter. Okay, the entire chapter is comprising of this section, the sections and the deductions that is allowed under those sections. Then we have section 80 triple C, pension fund contribution. See here, the total deduction allowed is 1.5 lakh. If you are contributing to any annuity plan or say LIC, okay. So total deduction to the extent of 1.5 lakh is allowed and the SSC can avail. Then we have section 80 CCD, which is National Pension Scheme. I believe most of you would have the idea of National Pension Scheme and Atal Pension Scheme. Okay, so National Pension Scheme is for the uh, people. Then see, if you are contributing self to this National Pension Scheme, so maximum 10% of the salary or 20% of the gross total income is allowed as deduction. And then additionally, uh, 50,000 additional limit is allowed. Then if the employer is contributing, so 10% of the total salary is allowed as deduction to the SSC. Okay. So this is about 80CCD. Okay. Then we have 80CCH. This is newly introduced because I believe you may be knowing about this, the Agniveer. So this Agniveer scheme has been introduced recently, and this is to encourage the Agniveers, to motivate them. See, full contribution, the complete corpus fund is allowed by the government as deduction for the Agniveers. Okay. Basically, the Agniveers have enrolled after 1/11/2022. So complete complete corpus fund is allowed. Okay, full complete corpus fund is allowed to the Agniveers as deductions. Okay. See, now these are certain things which are of social welfare nature. Certain sections are there. See, we have section 80D. Okay. Section 80D. See, this is medical insurance. So medical insurance for self and family up to 25,000 is allowed as a deduction. But if it is a senior citizen and if the medical insurance is for the senior citizen, then to the extent of 50,000 is allowed as a deduction to the SSC. The SSC can avail up to the extent of 50,000. Then if the medical insurance has been taken for the parents, then 25,000 rupees is allowed as a deduction. If the parents are senior citizen, then 50,000 rupees is allowed as a deduction if the parents are senior citizen. Then even 5,000 additional in excess is allowed for preventive checkup. Then let's go ahead with section 80DD, maintenance of disabled dependent. See, the disabled person in the family is basically the dependent person, dependent on the rest of the family member or say the SSC. Okay, so if SSC is maintaining the responsibility of any disabled dependent, then 75,000 limit of deduction is allowed if the disability is to the extent of 40%. If the disability is to the extent of 80%, if the dependent is 80% disabled, then in that case, the SSC can avail a deduction of 1,25,000. Okay, from his gross total income, he can avail a deduction of rupees 1,25,000. So here, basically, you have to remember the extent of disability. Okay, 75,000 is allowed as a deduction from the gross total income if the disability of dependent is to the extent of 40%, if he is 40% disabled. And if the disability is up to the extent of 80%, if the dependent is disabled to the extent of 80%, then 1,25,000 deduction is allowed to the SSC from his gross total income. Then we have section 80DDB, treatment of specified disease. Now, when I say specified disease, these are the life-threatening disease like cancer. Okay, so if there is a treatment going on for such diseases, so the deduction of rupees 40,000 is allowed to the SSC. And if the treatment is going on for the senior citizen, if it is a senior citizen, then to the extent of 1 lakh rupees, the deduction is permitted. Okay, so basically you have to understand here, treatment of specified disease refers to the treatment of life-threatening disease. So if there is a treatment going on for the life-threatening disease, if he is not a senior citizen, then to the extent of 40,000 is allowed as a deduction. He can avail as a deduction. But if it is a senior citizen, then he can avail or enjoy a deduction of 1 lakh rupees. Then we have section 80E, which is education loan interest. Basically, see, here the government has been kind. There is no limit specified here, but it can be availed to the extent of 8 years. Okay, educational loan. So people take educational loans for the purpose of studies, for the purpose of education. So the limit is not specified, but it can be availed up to extent of 8 years. Okay, so that is dealt by section 80E. Section 80E deals with the educational loan interest. So interest amount is allowed as a deduction to the extent of 8 years. Then we have section 80EE, say interest on home loan. Basically, first, especially for the first time buyers. See, having a first house is a dream of all. Okay, and the government is supportive to the citizen in fulfilling their dream of having their first house. So here the government allows 50,000 rupees deduction to the SSC, the interest amount, okay, on home loan up to the extent of 50,000. Then we have section 80EEB, interest on electric vehicle loan. Okay, interest on electric vehicle loan. So here the government is also aiming to encourage electric vehicles because they are eco-friendly. And in order to encourage use and usage of electric vehicles, the government is granting or allowing deduction to the extent of rupees 1,50,000. Okay, so the interest amount can be availed for the electric vehicle loan Okay, this is basically aiming to encourage the usage of electric vehicles. Then basically the easiest way to remember this is section 80C mostly deals with your investments, like investments in insurance or PPF or Sukanya Samriddhi Yojana. So any kind of investment, whereas section D deals with your treatment and disabilities. Okay. Now, when it comes to section 80E, 80E is all about the loans. Okay. So that is the easiest way to remember them. When it comes to E basically talks about the loans. Then you have 80G. 80G is all about charity and donations. See, you will come across all such terminologies again and again when you talk about 80G, donation, charity. So section 80G, let's take on section 80G. See, section 80G is donation to approved charity. There are certain charities that has been approved by the government. And if the SSC is making any donation to these government approved charities, 100% of the 100% of the amount is allowed as a deduction. In some cases, it qualifies for only 50% deductions. Okay. In okay, in certain cases, it also goes to the extent of a 100% reduction from to the amount contributed. Okay, so 100% amount is allowed as a deduction in very few cases. Okay, in majority of the cases, 50% amount is allowed as a deduction. So SSC can avail here if he has made any donation to any approved charity, basically to encourage donations, the behavior. Okay, so this is basically, you can say section 80 is of social welfare nature. Okay, now we have section 80GGA. See, section 80GGA is for scientific research and rural development. 100% deduction is allowed. Okay, this is for non-business taxpayer. It is not allowed for the business taxpayer. That means income from business and profession. So other than them, to rest of the people, 100% deduction is allowed if they are making any donation for scientific research or rural development. Okay. So this you have to understand that if you are making any donation as an SSC, if the SSC makes any donation in the field of scientific research or in the field of rural development, 100% reduction is allowed, but this is not for the business taxpayers. Like if someone has income from business and profession, for them, they cannot avail this. Then we have section 80GGB, that is donation to political parties. Okay, basically by the companies. So if they are making any donations to political parties, 100% deduction is allowed. Okay, 100% deduction is allowed. 100% deduction is allowed. So they can avail 100% deduction. Okay. In case of section 80GGB. So if they are making any donation to any political party. See, basically here, the government also is encouraging donation to political parties. 100% amount is allowed. Yeah. Publishers There is some issue. Just give me 1 minute. Just a second. Yes. So hoping that it is visible, we have section 80 GGB, which is donation to political parties. So if we are donating anything to the political parties, basically by the companies, 100% amount is allowed as a deduction. Okay. So the assessee can avail 100% of the charity or donation that he has made as deduction. So basically, this will also encourage more donations to political parties. See how cleverly they have, how the government has cleverly designed these deductions. Okay, then we have 80 GGC donation to political parties by individuals and HUF. To them also 100% reduction is allowed. Okay, whether it is donation made by companies or donation made by individuals, 100% of the donation that is made to the political parties is allowed as a deduction. Okay, so the SSC can avail the entire amount that he has donated to the political party. Okay. Then we have section 80 GG, rent paid. See, basically this can be availed when the rent is paid and the SSC doesn't receive any HRA. Okay, 5,000 per month or 25% of the total income, or rent paid minus 10% of the total income. Okay, so this we will deal it separately once we take a problem on income from salary. Okay, so there we will come across this, and the treatment also we will be learning of there. So right now if I tell you, you won't understand this. This is the moment when we take salaries chapter. Okay, there we will cover it. So for now, you remember, if there is no HRA being paid from the employment, from the job, then this deduction is allowed to the SSC. Then we have section 80 JJAA. This is basically for the companies to encourage new employment generation. 30% of the additional employee cost. That means if he is undergoing any training, so 30% of the additional employee cost for 3 years is allowed as a deduction. Okay. But it should fetch minimum 150 days of employment. Okay. So this you should remember, section 80 JJAA. Then we have section 80 QQB, royalty income of author. Okay. So if like authors will receive royalty once they publishes a book or once they publishes a paper, they receive royalty. So if they are receiving any form of royalty, maximum 3 lakh rupees is allowed to the SSC as deduction, but not for the textbooks. Okay, for a textbook, that deduction is not allowed. So 3 lakh rupees ka deduction is allowed to the SSC for non-textbooks. Okay, so SSC can avail a deduction of rupees 3 lakh from his total income under section 80 QQB. So basically, I believe you may be having an idea that the authors will receive royalty. Okay, once they publishes anything. Then we have section 80 TTA, saving account interest. Yes. See, when we open a saving account, the bank also gives us interest on our saving account. So the government also allows a deduction on the saving account if it is a non-senior citizen to the extent of 10,000 rupees as interest is allowed on the saving account as deduction to the SSC. So SSC can avail up to the extent of 10,000 rupees. Up to the extent of 10,000 rupees, the SSC can avail a deduction if he is a non-senior citizen from the total income. Then if he is a senior citizen, so for senior citizen, up to the extent of 50,000 rupees interest is allowed, interest income is allowed on saving account. Okay, up to the extent of 50,000 rupees. So this you remember. The only difference is TTA talks about a non-senior citizen and TTB talks about the senior citizen. For non-senior citizen, it is 10,000. Maximum limit is 10,000 as deduction from the gross total income, whereas for senior citizen, it is 50,000. Okay, 50,000 is allowed as a deduction from the GTA, from the gross total income. So this you have to basically understand and remember. Then you have section 80U. Just 1 second. Then we have section 80U, that is person with disability. For suppose if the SSC himself is a disabled person. Okay, so the government is not very harsh on such SSC. The government is being liberal on such SSC who is having any nature of disability. So if the SSC himself is a disabled person, so a total deduction of 75,000 is allowed if the disability is up to the extent of 40%. Because 75,000 he can avail it as a deduction from his gross total income. And if the disability is up to the extent of 80%, if the SSC is having a disability of up to the extent of 80%, then a deduction of rupees 1,25,000 is allowed to the SSC on his gross total income. Okay. So this is the case. This is the case that you have to remember. Now these deductions basically aim for, see, starting from here, ATC, investment and payment, ATCCC, pension fund contribution. Basically, you can remember 80, section 80 is talks about mostly investment nature of deductions. Whereas section 80CCH is a new one which has been introduced for the Agnipath scheme. Then section 80D is basically for the medical, like medical purposes, like treatment and disabled dependent. Then we have 80E. 80E is basically for the loans. Sorry, 80. Section 80 is basically covers. It basically gives coverage of all nature of loans. Then 80G covers all nature of charities and donations. Then we have 80JJAA, which talks about new employment generations. QQB is all about royalty incomes. Then TT, see, with the moment it comes TT talks about saving accounts. Okay, saving accounts of non-senior citizen and saving accounts of interest on saving accounts of senior citizen. Then 80U itself is for the SSC. If he himself is a disabled person, the government grants him deduction from his total income. If the disability is to the extent of 40%, 75,000 is allowed as a deduction. And if the disability is up to the extent of 80%, then 1,25,000 rupees is allowed as a deduction. So basically the motive of all these deduction is to reduce the tax burden of the SSC. And it also in one way encourages the taxpayer to pay his taxes honestly. Okay, because these deductions are allowed so that the taxpayer is not overburdened with the tax liability. Okay, so mainly they also aim to encourage the taxpayers by reducing their overburden of of tax payment. Okay. Some deductions are also of social welfare nature, I told you. So in one way, these deductions have also been allowed for the purpose of for the purpose of encouraging or promoting social welfare. Now, after this, the next chapter or the next block talks, the next block when we start, the next block is about computation of your total income. How do we compute total income? Okay. Compute means summarizing. How do we estimate the total income? So estimation process we will learn in the next class. How to estimate, how to summarize the total income. So deriving the total income, computation of total income, we will be learning. And once we get the gross total income of the SSC, then we can make use of all these deductions because these deductions are allowed from the gross total income. So once we learn the technique of computing the gross total income, then we will have an idea of using these deductions. Okay. So how do a SSC get an idea of availing these deductions? Have, have you ever thought about how do a SSC get an idea of availing these deductions? Basically, it is done through experts. Okay, if the SSC himself is not, if the SSC himself lacks an idea of using these deductions, then SSC will use a expert like chartered accountants are there who will be guiding him to utilize these deductions in order to reduce his tax burden. Okay. So basically the CAs, the chartered accountants, the SSC and these will be a part of their will be a part of tax planning of SSC. Okay. So the main thing you need to understand is the deduction is done from the gross total income. And we need to learn how to compute the gross total income. Okay. Once you are able to compute the gross total income, from that gross total income, you will be able to allow these deductions in the gross total income. Okay. And now you would have got an idea that tax planning is basically is for the purpose of availing these deductions. Okay. Why do people do tax planning? The main motive behind tax planning is to avail all these deductions. Okay. If we are eligible for these deductions, we can avail these deductions. That is the reason and that is the purpose of tax planning. And that is why people go for tax planning. Okay. That if they are eligible for any nature of deduction, they can avail those deductions. Because until and unless we are not availing those deductions, our tax liabilities will look bigger. Okay, it will look bigger. And our burden of tax payment would also be more. So you have to remember, I believe this idea you might be having. That is Income Tax Act 1961. Okay, so we have a separate law for this income tax, that is Income Tax Act 1961. So this is today's class. You have to basically understand the deductions are dealt from section 80C to 80U. Okay. And 100%, there would be something that you can expect because these deductions are, each of these deductions are very important. Okay. So with this, we are ending up the class for today, and next class we'll be joining back for the purpose of finishing our computation aspect, because computation aspect involves the main primary foundation of the subject. Okay. How to compute the total income, because when you go for tax filing, the main thing will be computing your total taxable income and computation of your gross total income through different heads, Okay. So that is one thing. Uh, so basically we have to do it.